Let me talk to you about the amount of negative yielding debt we've got out there then, Joe. We've got this, I've got this chart here. It's one that we've tracked the sort of almost relentless rise upwards above 17 trillion we got to, didn't we, a little earlier this year in terms of negative yielding debt globally. Well, now it's dropped by a touch down to around $16 trillion. Is this the start of something then? Do we bring this pile of negative yielding debt downwards?
Yeah, so I think it's hard. I mean, government bonds have been a great diversifier for multi-asset strategies over the recent past. The rally has really been a huge boon for many multi-asset investors. I think at this juncture, it's very tricky. What we know for certain when we do our valuation models is that longer-term duration is really not rewarded. We're being very penalised for taking duration risk. So we're having to pay the market a very high price, we think, to have that luxury of duration in our multi-asset portfolios. I think from an investment strategy perspective, what you then want to do is look at shorter duration strategies in fixed income, both in the bond space and in the credit space. But that's not quite the same as saying we're due for a rapid, imminent reversal in longer-term government bond yields. Because, of course, what we have seen is quite strong momentum, a lot of additional reasons, non-fundamental reasons that people have been buying those asset classes. So I think from our perspective as a multi-asset manager, what we want to be doing is taking advantage of shorter duration parts of fixed income as the offsetting element versus our diversified risk elements in our portfolio, and avoiding longer-term duration. But we're not sort of expressing a very aggressive tactical view on that part of the curve at the moment.
Does that duration, I'm working on the assumption, Joseph, that duration, that shorter duration, it's still in the United States of America. The whole of the Fed, the whole of the US curves, by the way, are all under the Fed fund futures. So is it still in the US you want to focus?
Yeah, there's a challenge with taking longer-term duration exposure globally at this point, Manus, because we think the valuation credentials really aren't there. 12 months ago, we may have made the argument for looking much more favourably on US government bonds. But at this point, whether or not you're looking at US or Canada, Europe or Asia, the bond risk premium, the reward that investors are getting for taking duration risk is very, very negative. And to me, what that means is that we're being asked by the market to pay quite a high price to get exposure to that part of safety asset class, and so as a multi-asset investor, I want to position portfolios in alternative, other safety asset classes which can help diversify my portfolio. Now that might be short duration fixed income in the government bond or credit area. It might be alternative risk premia, trend or momentum sort of strategies. But I think you've got to get a little bit more creative in how we find our diversifying strategies at this juncture, given what government bonds, the longer term duration maturities have done this year.